too many YouTubers, especially in the finance space. Number one, they're too fluffy.
Yeah.
Number two, they're hard to relate. And number three, they're repeating the same information that everybody else has already been doing, which means that it's very hard to relate to. And it only works for those tickers that we're referring to.
Right.
And so you can't adapt it. Nobody can adapt it to their own needs.
Right.
Because investing is very fluid and personal.
You're right. Because they're focusing on one asset.
Regardless of what people say, it's very personalized, and that nobody's risk tolerance.
Right.
Nobody is the same. Nobody is identical.
Well, and that's the other thing that you have to always, thread the needle on as being an influencer as well. It's like at the end of the day, I must repeat it 1,000 times. Look, this is the way I'm doing it. But what my needs, my situation in my life, and my investment goals are going to be absolutely guaranteed to be different than yours. All I could do is give you patterns. I can show you a pattern. Like when I show them the 3 pillars of income investing, I show you the pillars. It's up to you, each individual investor, to decide how much of this pillar do I want versus this versus this. If you're a very conservative investor, you could put all your investments only in conservative. So you can say, I'm only going to use pillar 1. So my strategy says, here are the pillars. You take the Lego blocks and decide which ones want to be in which one. So I'm giving them the freedom to know how to build their own portfolio and their own strategy, because I don't want to tell them, oh no, you should be maintaining. And that's the problem. And I think you said it yourself too, JJ. Too many people are too specific and too tangible. Like it's like, you must have a successful income portfolio, must be 35% yield. It's like,
or you must only go in growth.
Yeah, or
nothing
you must
else works,
only do growth, or you must only do this. It's like, no, that's
like
only for you.
Who are you to say? Like, what is your background? First of all, are you even qualified to say that?
Big bingo. The first one is half of them. That
are you even qualified? Like, what are your credentials to tell someone else who doesn't even have the same goals?
Right.
Who number two, who doesn't have the same risk tolerance? Number three, who doesn't even have the same risk capacity?
Right.
Which is the amount of income they can technically lose if there is a huge market correction.
Absolutely.
And number four, their family background, their technical background, their time horizon. Everything is very different. So who are you to say that you have to do something when you don't even know who you're talking to?
Right.
So what gives you the right, first of all, to say this kind of stuff?
Well, and that's the funny part is, and it's one
I'm calling
thing,
it out right now from.
And the funny part is, JJ, it's strange. It's acceptable to hear these kind of bad advice from people that are not experienced, trained financial advisors.
For sure.
But when you get, I'm not going to name names, but when you get that kind of advice or that kind of myopic, hammered down onto the table advice that the only good investment strategy is a growth strategy, and you didn't even, if you were actually a trained, certified planner or investment planner, the first thing they do is tell me what your needs are.
Exactly. What is it? What are your financial needs?
What are your needs?
What are your non-financial needs? Like, what do you want to get out of? Like, what is your long-term goal?
So how can you give advice?
The first step is not, go buy something. Yeah. That's not the first step. That's literally the last step of an ongoing process.
Yeah.
Yeah.
And so that's the part that really infuriates me, but I don't want to get into a pissing match with people like this. Like, let him do his own thing.
But it has to be said, now, off the bat. Like, nobody should be following blind advice.
Nope. Ever.
It has to be said.
If somebody tells you you should be doing anything, a growth investor saying, or don't do this other investment strategy or whatever, if they're telling you this, they're the first people that I would ban from my YouTube, because it's like,
first, hands off.
Yeah,
hands down.
If he doesn't even know what your needs are, and he's already telling you that it's bad to go in that direction other than my direction, you already know that it's not valid advice, because he didn't even take the time to understand.
Just a reminder, folks, that before delving into this full-fledged podcast, we are not licensed financial advisors. The content in this podcast and video is purely for entertainment and informational purposes only. Always consult a licensed professional before making any investment decisions. Remember, investments that aren't FDIC insured can fluctuate in value, and so please invest wisely based on your own needs and risk tolerance. Now, on to the podcast itself. All right, folks, this is live. So welcome to a new collaboration between myself, Convos with JJ, and we have a new guest, Perry from the PIIverse.
Hello.
So Perry, why don't you go ahead and do a little brief introduction?
Hey, JJ. Yeah. Thanks for inviting me.
Of course.
Christmas.
Always a pleasure.
our pre-Christmas video first meet. Although we did meet
Exactly.
in real, though, the first time we actually met in
Which was
real.
pretty exciting,
Yeah, that was
for
fun.
sure.
The Toronto thing was cool. So
It was a blast. Like, honestly, when I first, I was kind of skeptical about the whole Blossom event.
yeah,
I don't know. I think you were too, like,
yeah,
especially for the more PII focus or any kind of income or derivatives based investors.
yeah,
I thought I would have a not as good time
yeah.
just based on the fact that there's so much online drama
I
between the
know.
whole growth versus income debate, which is still happening to this day. But overall, it turned out that the community that we actually built
Yeah.
was very supportive and it is ongoing. So that's the part I really enjoyed, and we still maintain the connections to this date.
Yeah,
Did you feel the
are
same
right.
way?
I mean, honestly, I did the same thing. I was a little bit nervous because there was a lot of this, empire building between the passive income investors and the growth investors that seemed to always be
Growth
poking
fanatics.
at us, right?
Let's be honest here.
Yeah,
Come on.
the growth bros. I like what Adriano calls them, the growth bros. So yeah, so I sort of was a little bit nervous that they might actually carry over into real events, but it
Right.
wasn't there at all. Like, honestly, those that didn't want to meet with people like you or me just didn't meet with people like you or me, and those that
Exactly.
were open enough to say, "Look, I'm neutral. There shouldn't be any fences here. I mean, we should want to
There
talk to
shouldn't
both
be.
sides, right?" So it was great, and we so many people. It was so fun to talk to all you guys at that event. I just loved the weekend. So I tell you, I can't wait for next fall because I'm actually looking forward to the next.
They should have way more events if they're able to,
Yeah.
since it's such a growing platform and it's going worldwide. So why not have more events rather just having it once a year? It's have the in-person connection, which is what
Yeah.
everybody is so used to. Because nowadays, ever since COVID, everything has gone online,
Yeah.
which means that connections that were built, they're not the same.
Well,
Like having a remote connection versus having an in-person connection, it's
Totally
very
different.
different. It's very different.
It's very
Yeah.
different actually meeting somebody personally online. Like I got to sit down with Paul like before the event. We
Mhm.
sat around for like downtown Toronto for hours talking, and Heath and a whole bunch of other people I got to talk
Yeah.
for hours with. Just chit chatting, which you can't do on the Blossom platform, or you can't do it.
It's hard.
It's hard.
That's why we made this is actually why we made our little group. This
Yeah.
is what we talk about
So
now.
you chit chat amongst that, yeah. But the funny
Exactly.
part is we were going to do the same thing as the Blossom formal events in
Okay.
Winnipeg. So, and this was before I even started Blossom. Like I basically was starting my passive income journey before I even knew what Blossom was. And
Right.
I was talking to some of which are now my ex-coworkers because I'm retired. And they're starting to learn about passive income. So they're starting the seed of excitement. It's like, hey,
For
why
sure.
don't we just go to a coffee shop or go to a restaurant and just book a room in the back, and maybe 10 or 12 of us can sit down and just have like Winnipeg meeting rooms, right? Because I'm
That's
from Winnipeg.
exciting.
And then the whole thing with the Blossom event happened, and myself and my little fiefdom inside Winnipeg said, why don't we do our own event here, our first local Winnipeg event? And
Mhm.
it was just overwhelmingly successful. Like we
Right.
could have actually had more, but we kept it at 100. We ended up having 72 people show up, which was great. But it was so exciting, and so many people said we got to do this again, that we're actually looking at maybe doing a May one, but much bigger, like
Ooh,
even a
okay.
bigger one. Maybe we'll rival the actual formal tour events. But yeah. So yeah, it is fun because I mean, living in Winnipeg, for example, is a very isolated city. It's a major city, but it's in the middle of nowhere.
It's very cold and dreary, huh?
It's
From
very
what
cold.
I've heard.
That's been this week for sure. So you get that.
Same here in Montreal. It's bad.
Well,
I
you
guess
guys
it's not.
get
It's
the
probably
ice
not as bad in
storms and
Winnipeg.
stuff, which are terrible.
Yeah.
We don't get
Even in the past week, it's about -15, give or take.
Okay.
And even with the wind chill, it's about -20. It's hitting close to -20.
Yeah.
So like, it's getting there. But I'm assuming Winnipeg is probably even worse for the most part.
It has its highs and lows. Like during the two blizzards we had just last week, with that strong wind, we were at -38.
Wow.
But that's not normal.
That's
normally
something else.
Winnipeg is in the -10 to -15, 20 range, right? We hop around there. But I mean, you get a wind on anything, and of course you get a prairie wind, which goes at high speed. Wind chills climb up really fast. But anyways, I guess
fair
I
enough.
didn't even get to introduce myself.
Yeah, let's get back to the topic at hand.
Yeah, so my name's Perry.
Yes.
And I basically started a YouTube channel back in July 16th, 2 days before Paul. Better call Paul.
Shout
We
out
almost started the same day. So I started July 16th on that one. And it was only because I'm in the Blossom community, PIIverse in the Blossom community. And so many people were asking me over the last year and a half, because I have this spreadsheet that literally is like a mega spreadsheet that I use to track my entire portfolio. And everyone, I used to always show clips of it saying, hey, look at this, look at my, here's my yield on cost. And they're like,
jumbled mess?
Yeah, it's huge. So, and people turned around and said, Perry, I want to buy it. You wouldn't believe, I would have made more money selling it for $5 a piece than I would have made even.
Hands down.
It's crazy how many people have asked for it, right?
And funnily enough, when you first made that membership video, I don't know, I think I saw that post and there were a couple of trolls going against making money. I'm just like, hello, you're in a capitalistic environment. What's wrong with making money?
Well, no kidding.
As long as you're providing value for it, what the hell's wrong? Well, like no one's losing here. So what's the big deal?
What platform are they on? They're on Blossom, an investing platform where your purpose is to make money, right? It's like,
well, guess what? People have to realize you need to spend money to make money.
To make money. Yeah. It's like people think that, and you and I both know it. Anybody that's ever been any form of a YouTube content creator, it's not easy
so much
work.
Money.
It is so much work. I mean, I don't get paid enough to actually do what I'm making now. And
although to be fair, you got monetized very early on.
Yeah, I got monetized in 6 weeks, which I've been told was very fast. So
it's not normal. Gary's told me personally, and he has an advertising background. I'm like, okay, yeah, fair enough. Yeah. I'll trust his word for it.
Yeah, I don't know what happened. I just found that quick little niche that basically people just drew themselves into. But yeah, I monetized really quickly. I'm going, okay, this was easy. And then, Paul and Gary and Adriano, they're all saying, that you kicked butt there, because he says it took us like almost a year before we monetized, right? So
yeah, exactly.
Yeah. So I was like, okay, I lucked out. And a lot of it. So what I did is I created a YouTube. I did a YouTube video. I was not planning to create a YouTube channel. I was just wanting to do a YouTube video, because I said, look, I can't sell, and I won't even give away my spreadsheet, because it is just so big, so complex, so much care and feeding, that as soon as I give it to you, I'd be becoming a call center, because you'd be calling me almost every day saying, how does this work? How does that work?
One-man technical support.
Yeah, I would be one-man tech support. So I said, I'm not giving away my spreadsheet. It's just too hard. So I said, what I will do though, I will do a YouTube video, and I will walk through the entire spreadsheet on a YouTube video. And that way, anybody that's an Excel lover, that loves Excel or Google Sheets, whichever one you want to use, you might be inspired by what features I put in my spreadsheet, and you can create your own. Okay. So that's what I created on July 16th, is that video. And it just exploded. I had about 5,000 views on that first video. And it's like, okay, that sounds good. So everyone's like, come on, Perry, where's the next video? So
hey, you became an entrepreneur overnight at this point, right? I
became an overnight YouTube content creator and now influencer, which is just absolutely nuts. So anyways, this is what I do. My channel, and my viewers are going to want to know what you're up to on your channel. But
for sure,
on my channel, my focus is, I would say my focus is quite unique, because I don't focus on covering ETFs. Like, I don't sit there and say, how's Alti doing compared to its competitors, or what's the newest and latest from ETFs. I really don't talk much about ETFs at all. I talk about the passive income strategy. How do you invest? Like, what do you need to do to be successful in any kind of passive income or income investing strategy? Diversification, or there's another guy, ironically, so he's called himself, I think, the income architect. He actually gave it a name.
I know him very well. Yeah.
Yeah. He gave a name of what I've actually doing already. I call it 3x expense buffering, right? He's actually called it, I think, market downturn buffer, which is the same thing.
That's very it's the more technical term.
It's a better term than mine. I'll give him credit. Like, I wish I would have coined that term. That's a really
He's very like data driven, which is what I like.
Well,
and for a fact that if it's based on if it's test based, then it throws out all these kind of like erosion myths out the door, because then if you're allowed to back test it, then there's a higher chance of survivability.
Well, and that's the funny part, because honestly, him and I, we've never talked to each other, but we both were architects in the IT business. That's why he called himself the income architect, I think. I was an IT architect myself. So both of us have that background of 30, 40 years of basically taking very complex business problems and turning them into solutions and coming out with, okay, I mean, when you were working as an architect, you had to answer all the senior businesses' needs, right? I mean, we're talking large, big mega businesses. And you're like, you know, if I'm going to invest $20 million on this, where's the diversification? Where's the high availability? How are we going to deal with this? How are we going to deal with that? So we were always trained as architects to look at every element of a problem, you know? So
there you go.
It was just a natural for me to take that kind of knowledge in IT and move it into finance and into investing. And I think the income architect, he does it the same way. I can see his nuances like mine. It's basically you look at a problem and say, okay, let's talk it through and figure out how we're going to do it this way. And he does charts just like I do charts. Like he does visuals that basically show, you know, here are the three, like I just started about the 3 pillars of income investing. And so
I saw it. It's pretty good.
Yeah. But I've always been that way. And I'm sure the income architect does it the same way because we were always trained to understand the problem, build a pattern, and then basically understand what the pattern is, and then basically build a strategy that can actually
build the foundation
of that pattern. Because if you've got a pattern, you can repeat the pattern. That's the whole thing with the pattern, right? So, and you can see when I did the 3 pillars of income investing, it's a pattern because you can call it whatever you want. You can give it whatever different names you want. But at the end of the day, there's the conservative investor. There's the midline conservative, a little bit of aggressive investor. And then there's a portfolio that's very aggressive, right? Well, those 3 pillars.
And then there's and then there's something else somewhere out there.
Yeah. And then, then there's
something
like
out
crazy,
there.
Then there's crazy gambler. I just went to the casino. So
exactly.
But I mean, honestly, you could give it different names, but at the end of the day, the pattern is that there's a spectrum from conservative to aggressive, right?
Right on.
And if you could sort of take that concept and sort of say, but how do I do it in a way like when you're an architect and you have to try to present your solution to senior leaders like CIOs and stuff like that, they don't understand this technology.
The technical side, yeah.
They want to hear
They don't
it in a
care.
way that
They don't care. They want the big picture.
They want the big picture. So we were always trained to somehow make something that's really complex with wires and turn it into something that can make sense to a CIO. And so I think that's why with my YouTube channel, it's working out really well because I'm doing the same thing with investing and income investing as I did with IT. I'm trying to get the ugliness and the technicalities and make it a little bit more simple to understand, right? So
I think that's where you're hitting home. I think too many YouTubers, especially in the finance space, they are number one, they're too fluffy.
Yeah.
Number 2, they're hard to relate. And number 3, we're repeating the same information that everybody else has already been doing, which means that it's very hard to relate to. And it only works for those tickers that we're referring to.
Right.
And so you can't adapt it. Nobody can adapt it to their own needs.
Right.
Because investing is very fluid and personal.
You're right. Because they're focusing on one asset.
Regardless of what people say, it's very personalized and that nobody's risk tolerance.
Right.
Nobody is the same. Nobody is identical.
Well, and that's the other thing that you have to always, thread the needle on as being an influencer as well. Is like at the end of the day, I must repeat it 1,000 times. Look, this is the way I'm doing it. But what my needs, my situation in my life and my investment goals are going to be absolutely guaranteed to be different than yours. All I could do is give you patterns. I can show you a pattern. Like when I show them the 3 pillars of income investing, I show you the pillars. It's up to you, each individual investor, to decide how much of this pillar do I want versus this versus this. If you're a very conservative investor, you could put all your investments only in conservative. So you can say, I'm only going to use pillar 1. So my strategy says, here are the pillars. You take the Lego blocks and decide which ones want to be in which one. So I'm giving them the freedom to know how to build their own portfolio and their own strategy, because I don't want to tell them, oh no, you should be maintaining. And that's the problem. And I think you said it yourself too, JJ. Too many people are too specific and too tangible. Like it's like, you must have a successful income portfolio, must be 35% yield. It's like,
or you must only go in growth.
Yeah, or
nothing
you must
else works,
only do growth, or you must only do this. It's like, no, that's
like
only for you.
Who are you to say? Like, what is your background? First of all, are you even qualified to say that?
Big bingo. The first one is half of them.
Are you even qualified? Like, what are your credentials
Right.
to tell someone else who doesn't even have the same goals?
Right.
Who number 2, who doesn't have the same risk tolerance?
Well-
Number 3, who doesn't even have the same risk capacity?
Right.
Which is the amount of income they can technically lose
Right.
if there is a huge market correction.
Absolutely.
And number 4,
Yeah.
their family background, their technical background,
Right.
their time horizon, everything is very different.
Yeah.
So who are you to say
Yeah.
that you have to do something when you don't even know who you're talking to?
Right.
So what gives you the right, first of all, to say this kind of stuff?
Well, and that's the funny part is, and it's one
I'm calling
thing,
it out right now from
and the funny part is, JJ, it's strange. You know, it's acceptable to hear these kind of bad advice from people that are not experienced, trained
who are
financial
newbies,
advisors.
for sure.
But when you get, I'm not going to name names, but when you get that kind of advice or that kind of myopic, you know, hammered down onto the table advice
Exactly.
that the only good investment strategy is a growth strategy, and you didn't even, if you were actually a trained, certified planner or investment planner, the first thing they do is tell me what your needs are.
Exactly. What is it? What are your financial needs?
What are your needs?
What are your non-financial needs? Like, what do you want to get out of? Like, what is your long-term goal?
So how can you give advice?
The first step is not, oh, go buy something.
Yeah.
That's not the first step. That's literally the last step
That's the
of an
last
ongoing process.
Yeah.
Yeah.
And so that's the part that really infuriates me, but I don't want to get into a pissing match with people like this. Like, let him do his own thing.
But it has to be said, like, now off the bat, like, nobody should be following blind advice.
No, ever.
It has to be said.
If somebody tells you you should be doing anything, a growth investor saying, or don't do this other investment strategy or whatever, if they're telling you this, they're the first people that I would ban from my YouTube, because it's like,
yeah, first, hands off.
yeah,
hands down.
if he doesn't even know what your needs are, and he's already telling you that it's bad to go in that direction other than my direction, you already know that it's not valid advice, because he didn't even take the time to understand. Like, these kind of people don't turn around and say, there are good times and there are times, like, if they would have taken a more neutral approach saying there are times when passive income investing is really good. And I tend to not be in that kind of camp, but these are the opportunities where it can be. Then people would say, okay, I'm okay with that, because you're not saying no, you're just saying it's not for me, right? So anyways, so I stick to my channel, stick to my lane.
Oh yeah, so now that we're mentioning the 3 pillars for viewers who are not familiar with what you're referring to.
Remember, this has really been taking off. I've done 3 videos now on it. So the 3 pillars of income investing, or any kind of income investing, is you're basically, when you're doing a passive income strategy or any income strategy, like, you could be just all dividend stock. So it doesn't have to be passive income, AKA cover call ETFs. It could be any form of income investing. It's basically, the idea is, where are, like, if you took the pillars away, you just say there's a spectrum from extremely conservative income investing to very aggressive income investing. So, and if you look at it, you'll see, and again, we talked about patterns, you will see what the patterns are for basically a very conservative income investor. They will stick to things that are like dividends from blue chip stocks. Yeah. They actually dipped in and went
like dividend growth, pretty much.
Dividend growth stocks. Like, those guys were like, yeah, I'll take it for the growth, but I buy Enbridge not because of its growth. I buy it because of its
for stability.
It's beautiful, stable, always increasing dividends, right? So they're buying it for the dividends, right? But then you move away from that and move into the passive income strategy, which is more, I'm buying investments whose only purpose in life is to generate income. That's their, if they grow, it's a bonus, but they're focused on income generation, right?
Right.
And so when you go from dividend stock, you move into the passive, you start right at the very conservative side. So those that are very stable with growth, I won't say NAV growth, but they have the opportunity to grow, because if their underlyings grow, they can grow with it, because the way that the ETF is structured is that it gives it the freedom to go up with the underlying, right? So NAV stability, I will call it NAV stability, not NAV growth, because people will think that you are guaranteed growth. You get NAV stability, right?
That's a better term.
That's a better term. So I will follow the underlying very closely. That's really the better way of understanding that. But I fully understand that I'm not going to get the kind of crazy yields that the guys over there to the right are getting. Like, I'll get maybe...
But also the extreme volatility that comes with it.
Exactly. So the point is, and you can actually see, I've created multiple charts on this in past videos. As NAV stability goes down, as yield goes up, NAV stability starts going down. Like, it becomes more volatile. As you get more and more to the extreme side of the spectrum, you now get from NAV, I call it a nickname, I call it NAV lag, which is an acceptable version of lag, of NAV drop. It's called NAV lag. And then I
Okay.
moved down to what's called NAV erosion, which is it's the ugly form. It's the one when you're really extremely going for the maximum yields, you're going to have a very good chance of an ETF actually doing NAV erosion, which basically means that even if the underlying is staying stable or going up and down, the ETF's NAV is dropping. It's like you could see the NAV of the ETF dropping. And you can actually watch it. And I've done actually charts. We talked about the market tech. I've done actual charts that you can actually see what a NAV eroder is. And you can see every time there's a distribution, it drops a little in NAV and it can't recover. Drops a little bit and it can't recover. And you can see it actually dropping. That's NAV erosion.
I mean, because I think at that point, the ETF itself is not paying out. It's paying way more than they've earned. They're paying it directly out of the NAV.
And that is exactly.
I mean, fundamentally, they can't recover.
They can't recover because
they're paying.
Because what they're trying to do is they're trying to hit yield targets that they can't actually hit. Now I see that there's a change. There is absolutely a change happening. Like, Yield Max has already shown some change in it on some of theirs. Just recently, like, look at what they did. They totally overhauled Alti after their 10-to-1 reverse split by putting in a lot of blue chip tech stocks into their underlying, and they're going to be likely. Won't shock me at all if their monthly or their weekly distributions are going to drop dramatically. They're going to be a lot more stable.
Or 60%.
Hey,
it's going to drop like 50 to 60%.
Yeah, I think so too.
Complete 180.
It is. They're going to go from 114, 110, 80, 90% yield. They're going to drop down to like 40, 50, 60% yields because they're putting in a lot more conservative things. But the whole concept of this spectrum from conservative to extreme was a very linear type of line. What I wanted to do is actually do something that made more sense to the average human. And that is like create buckets. I ended up calling them pillars, but create buckets. Say, okay. So if you have 3 baskets and you're an income investor and you have a portfolio here, put 3 baskets in front of you. I call them pillars, but let's call them baskets. You put 3 baskets in front of them. And if you're a conservative investor, and let's just say you have a bunch of apples, oranges, and pears, where are you going to put those? Are you going to pick the ones that are in the basket for conservative? Are you the ones that are sort of mid-range, meaning I'll take a little bit of NAV instability, but I want that better yield? Or do you want the ones that, look, I'm a risk taker. I'm willing to go for really aggressive, so I'm going to go into that pillar. So my 3 pillars were actually, I gave them a more common name so that they're easier to understand. I called them the anchors, which are the conservative ones. The boosters, which are basically gives you a little bit more income boost, yield boost than the anchors did. And then I call them the juicers. The juicers are basically, you're squeezing that orange for everything it's worth. The yield is coming out of it. But when you're doing that, you're getting some really wild bronco riding on your NAV.
Like MSTE?
Like MSTE, yeah. So
I'm pretty sure like everybody who's familiar with MSTE or anything that tracks strategy is gonna go underneath that extreme juicer end.
That is
unless you have an opposing opinion.
Well, and that's the thing. So the whole idea with the videos, if anyone wants to know what they are, so I called it the 3 pillars of income investing. So it talks about, and I actually create a table that says this is the criteria of what makes up an anchor. Now, and these are the criteria that makes up a booster, and this is what makes up a juicer. So I've given my viewers the criteria that says, look, I'm not going to give you a whole phone book of what are all the ETFs, because Harvest is not going to come out and say that I've created my new juicer or the name is synonymous to me, not to them, right? So what I did is these videos basically help the investor say, okay, Harvest just came out with HHIS. Okay, Perry says, okay. So that looks like it's that's a booster. So I'm going to put it in the booster class. So it helps them classify each one of their investments. And now it's just amazing because it transforms your view of your portfolio. Because now people said, now that I did that, because I've had a lot of people giving me feedback, even in the last 3 weeks, they said, I went through the inventory myself. I have 35 ETFs and I went through each one of them. And I really thought I was a conservative investor, but I just realized how many boosters I had. And it's making people rethink because they didn't actually look at their boosters as being boosters. They just looked at it as just being an ETF that generates 34% yield, right? Or they didn't really have a category for it. But now they can actually say, okay, if I'm conservative, I should really put more target weight towards my anchors and a lot less target weight toward my booster. And right now I'm this way, and I should really try to get my portfolio more this way because that's the way what my goal wanted to be. So
For
that's the
sure, for
whole
sure, for
idea
sure.
with the pillars, and
Mhm.
it's helping people do it. And then I just did a video today or yesterday. I used
Okay.
Snowball Analytics. And I found out that Snowball Analytics has a cool feature for 2 years I never used. It was called categories, and you can literally categorize
Oh,
your investments. So I actually put
really?
the
Okay,
three
now that's
pillars.
that's fascinating. That's pretty cool.
It's so cool. It totally visually changed my whole portfolio and my Snowball
Okay.
because I can now actually, and
I'll probably
all their
start using
charts
it
are
then.
related to that. So you could turn around and say, show me the growth chart of my portfolio, but break it down by pillars. So I can see how my boosters are going versus my juicers independently on the charts now. So really cool,
Exciting.
really cool. So
That's really cool.
yeah. So anyways,
So actually,
that's what that is. So
very cool. So when you refer to those three pillars as okay, three pillars or baskets or what do you
yeah.
want to call it, how do you determine is there some kind of fluidity between the classifications or are they more so in one specific basket per se? Or is there some kind of fluidity where one ETF can flow in between those
No.
two categories?
Yeah, okay. So I give a criteria so that it's easy to so it really if you use my criteria, you could say, okay, based on what he's saying here, basically
Hmm.
this falls under the category of an anchor. So what I turn around and for example, I think I have about 5 criteria that sort of says
Okay.
this is what it is. So for example, an anchor must be a composite ETF. It cannot be a single stock. If it's a single stock, it's immediately identified as a juicer. I don't even care if you're a low yielding juicer. As soon as a cover call ETF uses a single stock underlying, it is already identified as a juicer because
Okay.
it's deemed right away to be a much more volatile ETF because you're working it only on one underlying.
MSTE.
Yeah, MSD. Yeah. Well, even what's it called? LH. Yeah. What's the one from
LLHE from Eli
LLHE?
Lilly, right?
Which yeah,
Yeah.
Eli Lilly. Like you look at it and okay, it's only like what 20% yield. Why would you call that
Oh,
a
by the way,
juicer?
folks, we are both Canadian-based investors.
Oh yeah,
So if people aren't unfamiliar with the tickers, we'll probably we'll go through a description of what they are and the underlying holding,
yeah,
so that viewers in the States or anywhere else around the world, they can use that kind of information for
yeah.
their own purposes
Yeah,
per
even
se.
if it's just for reference, they can say, well, let me go look up that
Exactly.
stock or that ETF,
Yeah.
right? Yeah. So what we're basically saying there is like Eli Lilly or which from Harvest is a very conservative um uh single stock ETF. Like I think its yield is only about
Relatively
20%,
speaking.
right?
Yeah.
Yeah. But what's really cool, and this is why I immediately call it a juicer, and this is when we talk about criteria.
Even at 20%? Huh,
I
okay.
think it's like 18 or 20%. I don't remember. I never have owned the stock. I
I
knew it
think
was one of the lower end ones.
Eli Lilly definitely has recovered to near all-time high, so it's probably on the lower side.
Yeah, I think it is.
Yeah.
It's definitely. I actually stayed away from it because it was under HHIS's yield,
Yeah.
and that was my rule. Was
HHIS, folks, is the Harvest high income shares, so the all-in-one basket. So
right.
it encompasses all 19 holdings of Harvest, which include Eli Lilly, Netflix, Costco, JP Morgan. You have Reddit, you have Circle,
Wow,
you
you remember
have the
them
Mag
all.
7, give or take.
You're
Yeah,
doing pretty good.
I like to know exactly what you're holding,
Yeah.
which should be the number one criteria
Right.
of what anybody wants to determine
Yeah.
what they want to hold.
Yeah.
It's not the ETF. That is just the on top ticker name,
Right.
which means nothing.
Yeah.
You have to look underneath and see
Check under
what
the
this
hood.
closed-end fund, what this ETF, or even
Right.
single stock ETF, what it does hold,
Right.
because it's going to track
Yeah.
that underlying
Yeah, you
from
should
a price
definitely know.
perspective.
Again, it goes under the basic rules of investing. Know what you're investing in, right?
Know the fundamentals. Yeah.
Yeah. So, and my rule for that one, again, apologies for the non-Canadians out there. HHIS is the all-in-one that covers all of Harvest's single stock higher income. So my rule there is if I didn't have, if the single stock ETF had a lower yield than HHIS, I wasn't going to invest in it. I only quote unquote juiced HHIS by picking the cover call ETFs that were in the basket, but I wanted more from them. So I only
Right.
have
Okay.
PLTE, MSTE, CYNE. I think that's it. That's the only ones I got on top of that.
Okay.
But the good example of what I've said is like even Eli Lilly's, if you look at it, it's still, even though its yield is relatively low for a single stock, it's only like in the 20% range. it is still quite a volatile stock. Like its stock goes up and down quite a bit. I called it, that would be deemed a juicer into my pillar. But
Okay.
if you turned around and look at the anchor, I turned around and said, okay, and again, these are my criteria. And I've told my viewers, you build your own criteria. I'm showing you what mine looks like. If you want to take my 3 pillars and create 4 pillars, or if you want to take the 3 pillars and change your criteria, that's fully up to you. In my criteria, an anchor cannot have a yield more than 25%.
25% is pretty high.
It's still high, but I wanted to give a maximum of where it had to end, right? Because then I say anything over 20% for really, it starts becoming a little bit more volatile. I was going to say 20, but I decided
20% is more safe.
Yeah, I think 20 would have been a more safer number. So, but I had it initially at 30. I moved it down to 25.
Okay. Well, you thought Biggie would fall under an anchor?
Yeah, well, I wanted HHIS to fall under anchor. Biggie never.
HHIS at 25% though, give or take.
Biggie's in the 30s, the low 30s.
I think it's smack dab at 30, maybe at 32% now, given its
well, because of the price changes,
minor correction.
With that, But they at the time they generally are over 30, and HHIS was under 30. So I basically said I wanted to have enough to capture HHIS in it. But then a lot of my viewers gave me some good feedback and said, I think you're a little too aggressive. So I said, okay, I'll move it down to 25%. But it doesn't mean that it's not bad. I mean, generally, it's anything between 20 and 25%. There's not that many in that range. They're either under 20 or they're over 30. There's very few that actually, it's a pretty empty space in the 20s. Like they either pick something that's aggressive or something that's really conservative, right? So I figured, okay, I'll just cut that in half. I'll say 25 and lower is anchors and 25 and up is boosters, right? So, and then boosters go from 25% to 60% because there's some pretty aggressive boosters out there.
Like what? Anything in particular?
Oh God, yeah, there's lots of them.
Give some examples.
Granite, YSPY, TQQY, they're in the upper 40s, low 50s in there. WPay is a booster. It's at 59.7% right now. So
really,
it almost moved to juicer level. WPay.
I think it should be because of its inherent leverage strategy, which actually moves even higher.
Well, that's funny.
I don't think this is a booster. It's more on the juicer side.
Well,
personally speaking.
Yeah. So what we did is we basically called juicers the juicers are the extremes. They're the ones that are using single stocks. They're going for yields over 60%. Like they're really out there. I mean, honestly, this is my view. A lot of people could have actually added a 4th pillar and actually created like anchors, boosters in the 25 to 40 range. And then you could have added 40 to 60. And then you could have had like extreme juicers between 60 and
instead
up,
of juicers being at that level, you can just say off the charts.
Off the chart. Yeah.
They're off the charts.
Well,
something else.
You just call them gamblers.
That's it. Yeah. That's what it is.
Yeah. So,
and I think, and clearly Alti falls in that list.
Oh yeah.
You're gambling.
It's funny you said that. I had to actually 2 days later, 2 days after my first video, I had to do another video that updated my criteria because there was a lot of pushback from me saying, because my rule initially was if you are a composite ETF, you fall under boosters, even if they're extreme. And a lot of people
What do you mean by
didn't
composite
like it.
ETF? What do you mean by composite ETF?
Composite means it's not single stock. It means it's either a sector, it's an index, it's a basket of multiple. For example, bank has all the Canadian banks, so that kind of thing. So I call them composites because they're made up of something, right?
I see. Okay.
So I turned around and I said, okay, if it's composite, it falls under booster. And then people said, no, that's not right, because that means Alti fits under there, and there's no way Alti is a booster. So I said, you know what? You are right. They have to fit between 25 and 60, and they have to be a composite. If it's not a composite, it's still a juicer. So Alti, and it took LFGY with it. Alti and LFGY got both booted out of boosters, and they got moved over to the juicer category.
I mean, I would say anything that tracks crypto should be off the charts.
Wow,
in my opinion.
Yeah, they are. I mean, they are. Well, but then again, I've got blocks, which is only 35% yield.
That's true.
Yeah, I consider like booster.
I would say blocks would probably be the exception and would fall under the booster category.
Yeah,
but
and again, boosters, in my view of the world, boosters are still risky. They are still going to be having the volatility. But you're sort of getting a little bit of moderation because you're covering an index or a sector, or you're sort of having a little bit of diversity in the covered call ETF. So that's why I still called them boosters, just because they have some form of moderation. Blocks will go down if the crypto market goes down, right? It doesn't go down if Bitcoin goes down. It has to go down if pretty much the industry goes down, because it holds the crypto.
Because I think it holds spreads and puts on Bitcoin and Ethereum specifically.
Yep.
But then it actually tracks the price movements of all the Bitcoin related companies.
It does.
Such as Strategy, Coinbase.
Yeah. Well, there's a whole
other stuff too there. Yeah.
Literally, if it's crypto, it's basically in there. And it's very much like LFGY. LFGY does the exact same thing. It basically does the same thing. It's basically a mishmash of technology and crypto. It has a lot of technology.
It's going to move the same. It's going to move, arguably speaking, they're going to move in the same direction, except for the fact that you're getting your return more from a yield perspective with LFGY versus stock price movement with blocks.
Yeah, and that's the thing. That's why I actually hold both blocks and LFGY. LFGY is a covered call. It is basically covered calls, and it really does have a lot of capping in it. And blocks, from what I've seen, blocks doesn't have that capping. It does allow an upside growth, and I think it's because they're doing the puts and the calls together.
Exactly. Yeah.
So I think right now,
and it also has I think 10% Ethereum exposure. Well,
yes.
I don't know if it's actually helping.
Yeah, I don't know if it's helping anything.
Exactly. Considering the fact that Ethereum moves even more volatile. Even more volatile.
Yeah.
It's even more volatile.
I mean, right
than
now,
Bitcoin.
it's hard it's hard. And I did watch a lot of other people from other influencers. Adriano is like the same thing. He said, let's go back and talk about Bitcoin, from the last crypto winter, right? I mean, when it was down in the 20,000 range or whatever, stuff like that, how many people then wanted to buy into it, saying, I'm not buying into that stuff. That's garbage. Well, it's hard to be positive in a sector that's really hurting badly. It's just like the oil sector, right? When it's hurting, it's the time people panic, but it's also the time that you should really be getting into it,
Right.
If you have belief that crypto will recover, which I do, I mean, it's hard to...
It has its cycles. It's going to rebound.
Right.
Yeah.
Why would you not be investing in them right now when everything's hurting? Like, that's why I'm really piling up a little bit more on blocks. Just because I think when the recovery does happen, I think blocks will go up with it. I'm not really investing in LFGY much because I'm already at my target weight. So because I'm at my target weight,
how do you decide your
one of my rules of investing is my target weights?
Yeah, no, sorry. Yeah, exactly. I was going to ask, how do you decide your target weights between the different, I guess, satellite versus like composites positions?
Yeah, so the way I do target weights is, so my whole portfolio is like, I currently have 34 covered call ETFs. Right. And I actually have 3 stocks. So I am a hybrid investor. I do have stocks too. So, but they only make up 15% of my entire portfolio. My income, it makes up 85%. So I have 34 covered call ETFs. My spreadsheet basically says, give me, every time a new covered call ETF joins my catalog, and I've actually, my strategy basically says, I can't invest in any covered call ETF or any investment unless it's been vetted and it comes into my catalog. So once it comes into my catalog, all my accounts can use it. I have 7 accounts. So my 7 accounts basically say, well, I can't touch LFGY because Perry's not put it in the catalog yet, right? So once I put...
Remember, folks, we're speaking to all the public for like everybody who's focused. Just because Perry or I don't have something doesn't mean that you can't have something. Like, don't copy.
No.
Do not blindly copy. It makes no sense.
No.
Like, everybody has a different taste.
And a different...
From a simplest perspective.
Absolutely. And that's why I said, like, we should have actually... Maybe you'll put the disclaimer in front of this video because... especially with all that stuff, we'll have to put our disclaimer. We are not investment or tax experts. We are just basically investors here telling you our stories, right? So, and please do not follow what we do. We're just telling our story. And if you're like, hey, I wouldn't buy that stuff, you're right. You shouldn't be buying it if you don't want to, right?
Mm-hmm.
So, but what I do is once it joins my catalog, let's say LFGY never was in there. Once it joins my catalog and I say, you know what, I like it. I think I want it to be part of my portfolio. I put it into my spreadsheet, and right away I have my allocation is based on 100%. So I have a holding weight of 100% from top to bottom. Right? And all 37 now, all 37 investments basically have to have a weight. It has to have some kind of weight that says, if you're in my portfolio, you have to have a part of my weight. So when I install a new ETF, I look at it right away and say, okay, what is this? Now, the good part, now that I got the 3 pillars, I can actually put a better classification to it. But before I had this definition of this pattern called pillars, I looked at it and said, you know what? This one's pretty conservative. Like, it only has a yield of about 15%. He's very conservative. He's very stable on the NAV. I think I'm going to give it a weight. Like, I have a rule that says none of my investments can exceed 5%. That's my personal rule. My investments have a 5% rule. Basically, you cannot have holding weight greater than 5. Now, I do allow it on exceptions, but I have to convince myself why I went over that number. 3 of them go over 5%, right? So, but all the others stay at 5% or lower, right? So I'll turn around and say, okay, well, if he's a very conservative cover call ETF, let's say like HYLD, I'll use that again. It's a Canadian one from Hamilton.
Yeah.
That's very
Think of it as an S&P 500 alternative.
It is. And it's very conservative. They're like, if you look at their charts, they're getting about, I don't know, 10 to 12% yields. It's a very low
exactly. It's 12.26%.
Is it?
After its recent
you're like
increase.
a machine. So so it's in the 12.
Hey, I'm a very numbers based guy. I like it.
So you could, I'm going to give you a number and you just tell me what it is. So
sure.
So definitely absolutely fits in my anchor category. Is 12%. It tracks the NAV very good. It's a solid, stable cover call ETF. So I'll turn around and say, okay, he's allowed to go all the way to 5% holding weight. So I could initially give it 5%, but then I turn around and say, okay, he is 5%, but he is an alternative to the S&P, and I already have USCL, and I was like, so I turn around and do sector weighting, and I say, okay, if my sector is already pretty full, I already got a lot of S&P, I might turn around and say, okay, if I don't want to be overweight on S&P. So if HYLD is coming in here, then that means USCL might have to come down, or I might have to sort of balance the two out because I've already got a lot of it here and I've got a lot of it here. So I might turn around and say that HYLD will come in. He's the new game in town. I might start him at 2% as a holding weight.
Okay.
And that's a trial. It's like a probationary period. After, say, half a year and he's really performing well, I could turn around and say, you know what, HYLD, you're doing good. Matter of fact, you're doing better than USCL is doing. So I will turn around and say, maybe it's time to rebalance. And I might turn around and say, okay, I'm going to give HYLD 3% and I'm going to pull USCL down to 2%. So my holding weight is dynamic, but it's sort of like when you do bowling and you put the guardrails up. And when you're doing, that practice bowling, it's the same kind of thing. The target weights is basically helping you keep in line with that cover call ETF, which is really good. Discipline when you're doing something like, for example, Alti. Like when I decided to finally invest in Alti, I finally said, okay,
you still have it?
I do have it. I bought it when it looked like it went down, and in the spring they stabilized it, and I thought, okay. They must have put things in.
Yeah, okay.
It was in the March. If you look in their March to April period, March, April, May period, you notice
it was relatively flat.
It went flat for a while. And then in the summer, it just kept going back down. So I thought, okay, you know what? They've started to put some put spreads in it. Maybe they must have put some protections in it. And it seems like it's doing good. But here's the thing.
Gee, I guess it helped so much, right?
Yeah, it didn't help much at all. But here's the good thing about having target weight. When I brought in Alti, I said, I'm not giving it. It is still extremely risky. It has shown a history of NAV erosion.
Right.
I'm going to dip my toe in it. So with that, I'm only going to give it a target weight of 1%. So that means I can invest up to 1% in it. I cannot exceed it. If there was a lot of other people that would have had a target weight system, they would have likely done the same things as because a lot of people were dripping it and basically trying to reinvest and DCAing it to try to get, it's going down. I'm going to get more. Oh, I'll go down. I'm going to get more. I don't do that. If it hits a target weight, I stop. I stop investing.
I think that's good.
Yeah.
That's a good way to put it.
And right now, my Alti is only at 0.9.
Yeah.
So
0.9%, huh?
Yeah.
Any chances you'll add to it, or what's your plan with Alti?
No, I you know what? And here's the thing. So, and again, now the Americans do know what we're talking about because Alti is an American.
Exactly. The Alti Yomax Ultra Income, right? So, I mean, just because we're Canadian investors does not mean that we know exactly what's in the U.S. side.
Yeah.
We'll talk about it for sure.
My portfolio is almost 50-50 Canadian to an American.
50-50?
50-50.
Then I guess let's come up with the first question first. How do you decide whether you want to buy a US product versus a Canadian product.
Oh, that one for
Do
me.
you have a sort of threshold?
I
Or
have
some kind of
criteria for that as well. So
Okay.
you will not see, even though there are some good ones, like actually I did a video only about a month ago because a lot of my, like actually now the majority of my viewers on my channel are now American. They're not even Canadian. So
Oh, what a switch.
I know it's
Okay.
crazy. Like I actually can see it, and it shows that most of my viewers are American viewers now. And a lot of
Gaining
them,
traction. That's a good thing.
yeah, and they were pushing me hard. They're like, Perry, I love your strategy, but the few times you talk about ETFs, it's all about your Canadian ETFs, especially in your base. Well, I call them now the anchors, but I used to call them my base ETFs. Those are the ones that are basically the same as anchors. They were like low yielding, very stable, the ones you can go to bed at night and never worry about them. So what I decided to do is that, you know what, you're right. I never look at American covered calls if they're under 30%. So, because when you turn around and look at a cover call, an American cover call ETF, and you put it in my TFSA or my RIF, especially my TFSA. So
just keep going.
So on my TFSA, they basically, you get hit with the 15% withholding tax.
Of course.
I said, okay.
And folks, we'll actually add on to that. If for those who are actually investing in those in your non-registered accounts, especially on the Canadian side, if you don't sign a foreign compliance form, which is the W-8 BEN form, the typical withholding tax is actually 30%.
Oh, I didn't even know that.
It's only if you sign that, because for any treaty, for any regulation, you don't have to be a Canadian investor. You can be anywhere else that are investing in U.S. products.
Oh, okay.
But that means that if for foreign investors that are investing on Canadian-based products, with the withholding tax on dividends specifically, or distributions, whatever you want to call it,
big.
On the entire distribution amount, it's 25%.
Yeah, I know.
And then for U.S. products, it's 30%. It's only because when you sign that W-8 BEN form, which signifies the treaty between U.S. and Canada, that's when it knocks down 15% to that 15%.
Oh yeah.
So if you don't sign that W-8 BEN form, it's actually 30%.
Yeah, because I know I have a German viewer that's actually been getting close to me with regards to talking about things. And he said,
oh, very nice.
He said that he says in Germany, I mean, if you try to invest in Canadian and American cover call ETFs, because they really don't have them in Europe, right? He wants to do them, but their taxes are ridiculous. And you said numbers like 25, 30% and stuff like that, right? So they're very restricted in getting access to them. So now with me, with my broker basically forced me to sign all
RBC, right?
Yeah, RBC. So basically, when you set up the account, it's like sign this one, sign this one, sign this.
Okay.
They literally walk.
I guess that's what you pay for a commission-based broker, right? They'll be more responsible.
Oh, I guess so. I just assumed that every broker did that. So I just
okay. Not with Wealthsimple.
No, okay, yeah, no, with me
you have to find it manually.
Yeah,
for commission-free ones, it's a different story. So
okay. Well,
there's more steps you need to take, but I guess the end goal is the same. It's just that for a commission-free one, you just kind of do you need to do a bit more homework and research.
And that makes sense. If you're going to be commission-free, you do have to accept the fact that they have to save money somewhere, right? So so with RBC, because they're a full service broker, they're going to do everything for you. So like they give you all the forms, you sign them all right there, and then as you're creating the account, like it literally, they take you there like, you better sign this one because we need it. You better sign this one because we need it, and all those kind of things, right? So anyways, so the reason when we brought up the idea is, when do you decide to do American? My rule is...
And why?
Huh?
And why?
Yeah. So my rule is I will not bring in an American cover call ETF if its yield is under 30%. And the reason I do that is because I hold everything in either TFSAs and RIFs. Now, in a RIF, it doesn't matter because there's no withholding tax.
Oh, you converted everything from an RSP already to a RIF?
Everything's RIF. As soon as I retired, I moved everything to RIFs. So
why not keep it as an RSP? Because you have until age 71 to convert.
Oh,
which
big
means
reasons.
That there's less. You don't have to withdraw until 71.
No, but I knew
right?
I was retiring, so I knew I was withdrawing. So there's no problem. And it was minimum. And you basically, the RIF forces you a minimal withdrawal, which... Forget about minimum. I'm at maximum almost. Like the number. Oh yeah, I withdraw tons. About 70% of my monthly income comes from my RIFs, right? So,
aren't you tax heavy then?
Yeah, I get taxed. Well, I get taxed like you're doing a salary, like a job. Like I basically get taxed like a job, right? So
yeah.
But the nice thing with a RIF is you're only you're restricted on your minimum, not your maximum. So they'll say the minimum you can withdraw out of a RIF is, say, $790 or $1,020. And I'll go, okay.
Per month, right? Yeah.
Yeah. So not at that per month, right? So then I turn around and say, yeah, that's fine. But I mean, I need more than that to live on. So I turn around and say, okay, no, I'm going to every month, $2,000 comes out of each one of my RIFs every month, right? So I get taxed equal to about, my wife and I, because the nice thing is she has a RIF too, a spousal RIF. So I have a RIF, a spousal RIF, a LIF, and a prescribed RIF. I've got 4 RIFs. So yeah, it's crazy because everyone has.
Your prescribed RIF is tied with an annuity then?
Which is that?
With regards to your prescribed RIF, is it tied to an annuity product then? Or no?
No. It's so a prescribed RIF is when you have a LIF or a LIRA. Basically, you have the benefit of
which is for folks who are not familiar, a LIRA or a LIF is a locked-in fund, so which is tied to your pension.
Yes.
So when you have a corporate-based pension plan and you quit your job,
right,
and after your vesting period, which is the amount of time your employer actually allows you to take your contributions, any employer's contributions,
right,
to a new plan, because it's a pension-based fund,
right,
which means that you can't withdraw it.
Right.
It has to stay in that fund, which means that it transfer into a locked-in fund.
Right.
That you can which means that you can start technically taking them out.
Right.
During retirement, which has both maximum and minimum rules.
LIFs are restricted.
Right? Okay.
Now, LIRAs aren't restricted because you can't even take the money out.
You can't even take it out. Yeah. LIFs are restricted.
LIFs are restricted because LIFs say that not only do you have a minimum, you also have a maximum, and it's
right.
And they do it because
it's a pension, right? They can't allow you to run out of money too early.
Yeah, they are trying to treat it like a pension. So they're like, well, you abandon your corporate pension, I'll pretend to be your pension, and that's how they do it with a LIF. But
gotcha.
The benefit of a LIF is, and every province is different. Again, apologies for the American viewers, but
I'm pretty sure they have similar rules.
They have different,
in the States. Just check with your state.
Yeah,
it's gonna be
401ks and all those their IRAs and stuff. They all have similar kind of rules. But in Canada, with a LIF, you can have a one-time 50% withdrawal at time of one time you can take out 50% of your LIF. So what I did right away, you want to get as much out of your LIF as possible because it's restricted and you don't want restrictions, right? So as soon as I converted my LIRA to a LIF, I moved 50% of it out of the LIF. It has to go to a RIF, and they call it a special RIF. They call it a prescribed RIF. So all it is a RIF that came out of a LIF. That's all it is. It basically has no rule differences than a RIF. Like, there's no difference between my normal RIF and my PIIverse. They do the exact same thing. The only thing they say is it came from a LIF, so they call it a PIIverse, right?
Gotcha.
Yeah. Now,
okay.
Other provinces
simple
call
name
it
change,
something
all the
different.
same.
Like I think Saskatchewan and Ontario or something, I think they call them SRIFs, or not meaning spousal RIF. They call it like a special RIF or something like that. They got another name for it, but in Manitoba, it's called a PIIverse. So that's why I have 4 of them. I have my RIF. I have my wife's spousal RIF. I have the LIF, and then the 50% that came out of there went into this one, so that became my PIIverse. So I have 4 RIFs, and all 4 of them pay every month on the 15th of the month. So I basically, again, I am 90.
And then, so with regards to all those accounts, are they 50-50 between Canadian and U.S. or mostly U.S.?
They're almost all of them are treated the same way. Like, I don't really have any differences. Let's just say all my RIFs are pretty much the same. They basically, if I have 34 ETFs in my catalog, my 4 RIFs have all 34. So sometimes they have a gap.
Okay.
Yeah. So if you want to know how many holdings I actually have, I have about 130 holdings actually.
But like quadrupled, like repeated 4 times, right?
4 LFGYs, 4, whatever, right? Yeah. So because every
does
account,
it not get very complicated, overtly complicated per se?
It's not. I mean, I would love it to be just in one RIF. It would be really make life a lot simpler for me, but I can't do it. I mean, that's the restriction I've got, right? So, and then of course, same thing with the TFSA. There's nothing you can do about it. A TFSA is a different type of an account. You have to be separate. And because my wife and I both have one, you have to have 2 TFSAs because you can't share. They both have to be their own. So I have 2 TFSAs and 4 RIFs. And then I have a non-registered, which I use for my investments. So all my RIFs and all my TFSAs have all American and all Canadian. They basically have 50-50 of everything. So, And so what it is that, and again, for those that don't know this already, if you put American cover call ETFs, the income coming out of an American cover call ETF is hit with a 15% withholding tax. So
not in a RIF though.
Not on a RIF, on a TFSA.
Yeah.
On a RIF, there's no taxes on a RIF.
They're like all retirement sort of accounts. So you have LIFs, you have LIRAs, you have
RSPs.
RSPs, yeah. I have my mind blanked out for a second. Yeah, RSPs and then RIFs, so RIFs, which is what RSPs convert to during retirement.
Yeah.
They all, because they are technically all under the same group as retirement accounts, then there is no 15% withholding tax.
Yeah, and vice versa. I believe the Americans have the same way. If an American held a Canadian cover call ETF.
Oh, cool. I didn't know that.
Yeah, I think the same way. They avoid the 15% withholding tax in their direction as well. Like, it's not just our direction, it's their direction too. If they held our...
So I guess those will apply to only 401k specifically.
401k,
whether a Roth one or traditional.
Yeah, I don't know. Like that, I know if they have a retirement account, it's actually in the same treat as our
Yeah, so it's under the 401k umbrella.
Designations in that, yeah. So
yeah.
So if it's in there, there is no 15% withholding tax, and I know there's definitely not on our direction. So,
are you sure?
Yeah, I better be. Yeah, so because somebody's making a lot.
You're unknowingly losing 15% every month.
Yeah. Now, this has basically become a very hot potato in the Blossom community because a lot of people didn't realize this. Again, I know that I pay an arm and a leg to be with RBC, but one of the benefits of RBC is that, and usually the large brokers are doing it, the non-discount brokers are doing this. ROC is exempt from the 15% because it is not income; it is considered capital return. Therefore, they can't. Right. When you do a 15% withholding tax, when you do a cover call ETF and they send you that distribution, that 20 cents per unit distribution, if that 20 cents has about, say, 40% ROC in it, that is exempt from 15% withholding, right?
Okay.
But
yeah, it makes sense because it's technically your own capital.
Because you can't tax your own capital back.
You can't tax your own capital, right? Because you paid it with after tax returns, after tax money.
The brokers, because and people don't understand this about ROC. The brokers, so when someone like YieldMax or Defiance turns around and says, we're announcing our distributions for Coney, and it was 85 cents, and we estimate the ROC to be 98%. It's an estimate. People forget that is not the actual ROC. That is the estimated ROC at distribution time. And the reason they can't do it is because these fund managers, these ETF managers, have to wait till they do their end of year tax reconciliation, where they actually look at all the distributions that they did on every one of them for all their holdings. And they turn around and do a reconciliation report and says, okay, after looking at all our things and our tax documents, again, I'm not a tax expert, but they turn around and say the actual ROC for Coney was 28%. They will give you an actual number. They then send those reports to any broker that wants them, like RBC. They get the report, and RBC says, okay, thank you very much. So for 2024, we collected this much. We collected 15% withholding tax from Perry. We have to give him back 22% of that because that should not have been taxed. So they actually, around March for RBC, they send back a refund on all the 15%. The ROC portion of the 15% gets refunded back to us. So, unfortunately for discount brokers, they don't do that. Wealthsimple and Questrade refuse to do it.
I don't think they have enough backside.
They don't have back office IT technology to do it. So
because they're all like remote based. So I mean, I don't think they can.
No, they can't. So if you're Wealthsimple, unfortunately, if you're Wealthsimple, it's up to
too bad, so sad. Then
it is. It's too bad. Well, it's not if you can't get it. You have to get your own tax accountants, and you have to go and retrieve that refund money from the actual U.S. government, I think, because the money goes to them, and you have to get it back from them, right? So,
well, I think it's also one of the main reasons why I'm getting rid of all of the U.S. holdings.
Yeah.
It's just there's no point because I was actually gonna go through this, but total return wise, you're actually you're not better, which is I guess it would be less of a identification or criteria for you because technically you're retired. But for someone in their earlier years, total return is the most important metric. You don't want to lose too much on the distribution side, which actually factors in way more, especially for higher yielders. You're actually losing more of that 50% that, well, big surprise, you don't get back.
Well,
and you have to
and we
deal
got
with
to keep in
currency.
mind, because total return and yield are different, but people got to remember
Yeah.
total return is made up of two buckets. And people
Mhm.
only, when they say total return, they only think about the growth side. They only think about NAV appreciation. Total return is a blending of income plus NAV appreciation, or
Yep.
NAV volatility.
Of course.
Well, and so when a growth investor always turns around and says, "Oh yeah, you're only chasing yield. You're not chasing total return. You're not focusing on total return." I'm going, "No. I'm not doing that."
Did you look at the total return chart when you said that first?
What's that? Oh yeah, like my total return. And I'll give you a good example of total return. So, and this is why it bakes people's noodles. There is total return, but a growth investor's total return is focused on growth. An income's investor's total return is focused on income, meaning
Right.
that most of my total return is more focused on the importance of yield generation. If you look at a growth investor, the most important part of a total return is their growth appreciation, right? So,
Yeah.
and I'll give you an example of this, because when I sold out of Coney, okay,
Okay, let's talk about Coney.
let's talk about Coney, because this is going to give people, for anybody who says that we are just yield chasers and not total return.
Oh wait, I'm not.
No. So, but you're being devil's advocate, and I really like that we're talking about this. So,
I have to be. You have to be. You need to play both sides.
And this is what
I
I'm
mean,
saying.
because you have to look at
Yeah.
an investment portfolio from all angles. It's not just one
Well,
side,
and
it's fluid.
and
for that
people
particular
don't,
reason.
if you don't dig deep enough, you may be being fooled because of all the shrills that are going on the YouTube, that people tell you, yeah, Coney, it's all about
I would say
erosion.
YouTube less so now.
Yeah.
I think there's some kind of crackdown, but definitely on Blossom.
Yeah.
For sure.
I hate saying it, but I haven't been watching many Blossom conversations as much as I used to on that. But
honestly, frankly, I don't have. Let's just put it this way: Blossom is a good tool just to put as a good social media platform.
Yeah.
But then again, it's still a social media platform.
It is. It still
which
has
means it's made of a bunch of shills, trolls, people who have way too much time on their hands and blaming others just for fun, and a small group of people who actually are there to learn. Well, guess what? For all the good things part of Blossom where you can pull good information, there's still a good chunk of misinformation that, frankly, people who don't have the necessary backgrounds are fooling people. I'm calling this out right now. Are fooling people into thinking that their way is the highway.
Right. Yeah. And
there's no other strategy.
These camps.
And again, the actual investment is a small part of one's overall financial needs.
Right. Yeah.
It's not the main thing.
Well, and you're right. So, I mean, at the end of the day, when you're doing investing, you have to look at the big picture. You have to look
of course, you have to.
And again, so for anybody, and again, this goes on both sides. There's extremists all over the place. You'll find it in Facebook,
everywhere.
just like you'll find it in Blossom, right? But I mean, for somebody, the people that are entrenched in their beliefs, like, I have nothing against growth investors. Hey, I have growth stocks. Matter of fact, one of my biggest NAV appreciations in my portfolio is
Athabasca oil or something like that, right?
oil.
Yeah.
Like, I've made tons.
You talk about it all the time. I'm just like, I remember this.
Yeah. Oh, yeah. It's my little darling stock. So I have nothing against growth. I mean, at the end of the day, they both serve a purpose. But for somebody that basically entrenches themselves in one thing and then makes it almost like a jihad, that literally, it's my way or it's wrong. It's the bad part about social media platforms is people really get entrenched in a belief to the point that they are not even open-minded anymore. Right.
I don't want to say that it's uncharted territory, but sometimes Blossom, because of the fact it's a deregulated platform, it's like TikTok.
Yeah,
you can sell anything.
Yeah,
you can provide anything.
Yeah,
but
it'll be interesting.
Are you accredited enough to provide that information? That's the first thing.
And that's the thing. It's going to be interesting to see, because honestly, like we talked about this thing that I think Jordan brought up, this thing about these new regulations or these new
crackdowns, on influencer providing advice,
for influencers. But you're almost wondering, like, is that also going to hit the social platforms on influencing platforms like Blossom?
They should. It shouldn't be just YouTube. It should be every platform.
Any platform
including TikTok, including Instagram, including X, well, Twitter, because I mean, still a social media platform, including Threads, should encompass everything.
Right.
Yeah.
Exactly. So it'll be interesting to see how these regulations actually affect even a platform like Blossom, which is all about influencing,
selling a
dream, about selling, basically my beliefs and stuff like that. Right. So again, nothing against Blossom. It's just a social platform is a social platform, and it has its goods and it has its bads. Right. I mean, it definitely was a good for me because I've actually became a YouTube influencer because of it. And I've learned a lot. I have to say, I have learned a lot. But you've got, when you're going into a platform like Blossom, and I told my sister, my daughter and my sister, when you're going to Blossom, I have no problems about you going in there for sure. But take everything with a grain of salt. Everything you
It's kind of like, it's uncharted territory, to put it at best.
What's that?
It's uncharted territory, to put it at best.
You're right. So the point would be is everything, just like you do in YouTube and Facebook, don't believe everything you read. If you read it and you find that, wow, is that true? Go research it. Don't just believe it. Go research it. So
don't take it as its face value.
Don't take it as face value.
Do your researage.
Yeah, do your research. So anyways, we talked about Coney. So
why'd you sell it?
So here's the thing. I finally decided to sell it because I mean,
you were pretty hardball on keeping it for the longest time.
I was
so what changed?
I was going to keep it. And the reason I was going to keep it is because here's the first thing. I was already at what I refer to house money status on it. I've had it for over 2 years. Basically, I had about 92,000 or 90 whatever thousand in investments in it. Like I had that much invested in Coney. I made about $94,000 in distributions over the same 2-year period.
So you only made $2,000?
No. So that's $2,000. It was income. Then I sold Coney and I made another $26,000 out of it. So basically, I had a covered call ETF that for 2 years was paying out $4,000 in income, of which that $94,000, I only withdraw about 25% of it. It goes out and gets withdrawn for me to live. The rest of my money, because I totally believe in a reinvestment strategy. The rest of it gets reinvested.
You have to.
So there are little Conies all over my portfolio because all the money that was not being withdrawn from Coney went into other things like WPay, like TS, YS.
Is YSPY basically
S&P
a put spread option on S&P from Granite
S&P.
shares, or
and it's I think 3 times
3x leverage.
3x leverage. One is 3x, and the other Granite.
Okay,
I think it's
something else.
Yeah, I think it's 2x leverage on their single stocks, and correct me if I'm wrong. I don't know it. I think that YSPY is 3x leverage. I can't remember which one it is, but because it's on an index, so I think it's bigger. So, but anyways, so
do you call that gambling then? Technically,
well,
X leverage.
It is leverage, yeah, but it's on an index, so I took it on like. Here's the thing: I don't consider leverage to be a risk. I consider leverage on a cover call ETF to be volatility, because people turn around and say, "Oh yeah, well you're buying a cover call ETF because it's got leverage. That's risky." No. If I am a buy and hold investor, there's no risk in it because all leverage does is make the underlying more volatile, right? If you still believe in the underlying, and I do believe in the S&P, all that 3x leverage does, it makes it go like this as opposed to like this. But if I'm a buy and hold investor, I'm going to basically keep holding it for a long period of time. So it will be still quite volatile. The only thing that would add a problem to that is if their cover call strategy caps their upside. So then you'll go like...
Hence yield max, right?
Yeah. Well, hence yield max, right? So anyway, so I ended up with Coney. The reason I got rid of it, I could have kept it, and it could have kept on paying me, a little bit more.
Were you holding it in your RIF accounts?
Hold it
TFSA,
on everything.
Or like
I held it in my TFSAs and in my RIFs. It was across all.
And you were okay with that 15%?
Yeah.
Every time?
Oh, yeah.
Okay.
It's gone. So, like, remember, 15% of 50% is only, that brings my yield from 50% to 42.5%.
Yeah, but okay, I'm gonna play the other side here.
Yeah.
You're still, because of the fact that distribution plays a huge factor on that total return. It's still a huge chunk.
Oh,
especially for those who are not in your position and just starting out, or at a way lower seed fund level.
Yeah,
it doesn't make any sense holding this.
Yeah, well,
that perspective,
the point would be is like, even if you take the 15% withholding tax out of Coney's was higher. It was about 80%. I remember what the number, but I'm using YSPY.
I guess then you're getting like 60%. Let's just say that.
Yeah. So you're still, and you turn around and look at it, there's almost no Canadian cover call ETFs that had those kind of numbers, right? I mean, everything in the Canadian cover call ETF market, 80-90% of them are under 30%. I'll say almost,
because they're not going to have juicers. Yeah, they know that.
Yeah, there are no juicers really. There are very few. Harvest now has it with PLTE and with and those guys, but that's rare. That's not even a juicer, in my opinion. That's a well-behaved juicer, if I have to call it that.
Except for MST.
Well, and
for
again,
now, I mean, because it's tracking the underlying, and the underlying is like, well,
this is not MST.
I guess a big surprise, right?
Yeah, like people are turning around and picking on MST. MST is following the damn underlying. It's if you want to blame somebody, blame MSTR. It's strategy.
Blame Michael Saylor, you mean?
Blame Michael Saylor. Then if you bought MST, then you better have believed in Michael Saylor, and you better have believed in MSTR. MST is just tracking the underlying. I mean, people are like crying about MSTEs. Like, well, then you shouldn't have invested it in the first place because.
Hey, you're still getting paid, even though it's very little.
Yeah,
very little, but you're still getting something.
Yeah, they dropped down.
It's still better than holding the. It's better than holding the actual stock. Well, you're getting zitch from that.
You're getting nothing if you hold MSTR. Here, you're at least getting a little bit of a distribution every month, right? So,
speaking of which, they actually cut it even further. Now it's down from 35 cents to 20 cents.
Yeah, they moved it to 20 cents. So I figured they would.
I think it's the lowest it's ever been.
Yeah, I figured they would have to because honestly, they couldn't have kept it. Otherwise, the yield would have been amazing. So anyways, with
probably
Coney,
gonna hit close to 100%. Yeah, something like that.
So with Coney, I ended up saying, okay, you know what? What I'm going to do is, if I'm going to move it out of Coney, give me something else that basically would have something similar to what Coney had without the kind of NAV erosion that Coney was actually showing. It literally was showing NAV erosion. So I did decide, you know what? I'm going to compromise a little. I'm going to go to COIW, which is Roundhill of Coney.
Okay.
It's a Roundhill.
What a switch.
It's Roundhill's version of Coin. So I moved to
Not
them.
covered call. Yeah, no covered calls.
Yeah. So they did it to them, and then I also put the rest of it into blocks. So I put some into blocks, and I put some into COIW, because honestly, Coney was a Bitcoin crypto investment. So I moved the investments out of Coney and into two like COIW and DBOLX, because both of those were cryptos as well. So I stayed within class, right? And I left Coney basically, I said, you know what? I could have stayed around with it. I could have watched it continue to NAV erode. Blocks, in my opinion, is not NAV eroding. It's just part of the crypto chill that's going on right now.
Right.
COIW, same thing. COIW is a lot more volatile because of its swap agreements.
Strategy.
Yeah, they're using a swap agreements. So again, I anticipate that COIW will go up when the markets go up.
When it comes to swaps, though, there might be a point where there could be issues when there's not enough swap agreements available to do those. So
you think that's possible?
Huge. I think it's a huge possibility.
Oh,
long term. So that's something you have to look at.
Yeah. So anyways, I moved it away from there. When I sold Coney, I basically ended up with getting house money, meaning all my investments were paid for. Plus I made a profit, not a profit. Plus I sold out the residual of about $26,000. So my end ROI, not yield, ROI was 19.7%.
Over 2 years? That's not bad.
19%. Like, who would complain about a 20% yield or a 20% ROI on a stock that everyone looked at and says, that thing's a dog. It's down. I'm down 78. Like, I think when I sold it down, I think 76%. Like, I was down 76%.
Did you sell it prior to the split or after before the split? Sorry, before or after the split?
I sold it. Split. I sold most of it before and one after.
Okay.
I got rid of it in stages. I got rid of it in September, October, and then the last part, I just wanted to clean it up. I just wanted to keep my portfolio a little bit more simple, so I wanted to get rid of an ETF. So I said, okay, I'm just going to get rid of the rest of it. So that happened just after the split, but the split didn't really matter. That's a technical thing, right? I mean, it would still erode with or without the split.
Yeah.
It was going down.
Until they fix their strategy, it's going to keep going.
Exactly. Now,
like it or not. Yeah.
And this is why I say I did a video also on, because that was the thing to talk about, is the reverse splits from yield max, right? So, oh wow, a dozen of them all went down.
I think it was Tesla, Ulti, Misty, and Coney who did the reverse split.
Yes.
Those four.
Wasn't there 12? Wasn't there 12 of them?
Oh, maybe, but I think I was only holding those four, so I just know those.
That could be those. Yeah. So but I did a video. It's like, honestly, the people, it was like, this is just a scam. It's like, okay, so let me get this straight about what happens with a reverse split. A reverse split, the party that gets hurt the most in a reverse split is the fund manager, because it is the worst PR campaign that they could get in their life. They make money on AUM going up.